Well, welcome everyone to our forum today on asset management and protection in the COVID-19 era. Today we'll be joined by Ryan Kanetoku, portfolio manager and financial planning specialist from Morgan Stanley, along with Julia Hsiao, an insurance and financial services professional from New York Life. My name is David Jang. I am chairman of Monty Jade West, and I welcome everyone today to join our event. Just as a reminder, this event is recorded, and we will have the recording live on our YouTube, Facebook, and also our website probably next week after this event. From a Q&A standpoint, if you have any questions, please use our Q&A function in Zoom. If you see a little button at the bottom, it says Q&A. You can ask speakers questions, and we will respond to them when we get to the appropriate time. Attendees can also upvote using their thumbs, so the best questions get bubbled to the top. In terms of the chat function, utilize them for general conversations between attendees. Panelists at this time will most likely not be responding because they will be in the middle of this conversation. If you have any questions and you need to get a moderator support, please raise your hand in the video and we will address it as soon as we can. And for best experience, please toggle to gallery view. You'll see this at the top right or bottom left of your screen, and it allows you to see all the speakers' faces at the same time. Monty Jade was founded in 1989 by immigrants from Asia. They bonded together to support one another because they were under-networked and under-resourced. Through this community, billions of dollars of enterprise value was created, and hundreds of companies were formed. Even to this day, Monty Jade is focused on building community. We do this today under 3 pillars. The first pillar is our interview series, which is focused on celebrating notable community leaders through the understanding of their personal journey and how they overcame them. Many of us face those same challenges, and the idea here is to better connect these great leaders with the next generation of leaders. The second pillar is focused on technology forums, in which we bring together our community to understand new ideas and new evolutions within trends in the technology ecosystem. This enables our community to discover new opportunities, not only for investments or career opportunities. Recently, we've held talks on venture investing, AI, biosciences, and we will have one on the communication sector coming up pretty shortly as well. Lastly, the most important pillar of our program is our mentorship program. This is a 100% volunteer-run program that is focused on helping build the skill sets of the next generation of leaders. Eastern Asians are underrepresented in the leadership of many Bay Area technology companies. Today, Eastern Asians continue to lag their peers in being promoted. White males are promoted at 2 times the rate of Asian males, while white females are promoted at 3 times the rate of Asian females. This disparity has gotten worse over the last 2 decades, and our mentorship program strives to help address this inequality. The 6-month-long program focuses on education and deep engagement with a small mentor family to help address some of these challenges of moving up and down, up the corporate ladder. We have started our open houses for this year, and we're about to kick off our full year's program. If you know anyone who's interested in the program, please have them apply online at montyjade.org/mentorship. At this time, I'd like to thank our sponsors. Thank you Deloitte, Venture Pack Law, Silicon Motion, and New York Life for continuing their great support of Monty Jade, especially in this time of COVID. Prior to COVID, we've had physical events, and they were backed by our annual sponsors that you can see here on the right. Namely UMC and Deloitte are our key anchor sponsors. They have been with us for many, many years as well. So we thank them for their ongoing support. At this time, I have a great honor of introducing 2 wonderful people. First one is Ryan. He's a portfolio manager and financial planning specialist with Morgan Stanley. He works with Cynthia Shen, who's a great Monty Jade supporter as well. And they look to provide highly personalized small family office experience focused on consultative strategies and holistic solutions for Silicon Valley executives, entrepreneurs, as well as their families. Both Ryan and Cynthia seek to establish lifelong professional relationships built on trust, satisfaction, and employing a disciplined process that follows a circular progression of discovery, advising, planning, implementation, and then tracking. Working closely with their tax and legal advisors, the team implements custom wealth management strategies, concentrating on asset management, planning, tax management, and estate planning. Ryan was born and raised in Honolulu, Hawaii, and earned his BS degree in finance and a master's degree in finance from the Levy School of Business at Santa Clara University. Julia, she is a insurance and financial services expert. She has extensive knowledge in this area of estate conservation and wealth accumulation since '97. She specializes in providing high net worth clients in California with customized insurance and financial strategies for themselves, families, and their businesses. She is a graduate of National Taiwan University's School of Law and also the Lincoln Law School. She has a JD from there as well, and Golden Gate University School of Law. She has a master's in taxation from there as well. I want to also first just set the frame of what's happening in our ecosystem right now. So, quarter on quarter on a seasonally adjusted basis, we've had the worst drawdown of GDP since the 40s. So this is a very, very severe time for us, 32.9% GDP drawdown on a seasonally adjusted rate. And so, we're hitting some pretty big air pockets, so to speak, in our path. On an ongoing basis, we've accumulated 59.3 million total unemployment claims, initial claims. Now, much of this is doubled up because of the closing and the openings and the closings again. But we're still here at around 881,000 claims on a weekly basis, and now those are incredibly high numbers. The highest during the last 08-09 crisis at any point was about 700,000. So we're still not in a great economic period of time. From a housing and eviction standpoint, a lot of evictions currently happening at this current time. One of the key stats right now is that 26% of Black families cannot pay next month's rent, and 50% of Hispanic families cannot pay next rent. So we're seeing a very, very large disparity in terms of what's happening in the ecosystem for many people. From a government support standpoint, the Fed came in very quickly, drove interest rates to zero bound. We did additional quantitative easing to additionally flood the ecosystem with more money. And lastly, we did some fiscal stimulus as well to the tune of $2 trillion, the world history's largest stimulus. But the markets are very, very disconnected from GDP. And with that, I want to pass it to Ryan, who's going to go a little bit more in depth in terms of what's going on in the markets. And Ryan, I'm going to pass it to you now.
Thanks, David. Good morning, everyone. Thank you to everyone at Monjade for having me today. As David mentioned, my name is Ryan Kanetoku, and I'm a portfolio manager at Morgan Stanley. A bit of background on myself and my team at Morgan Stanley. I've been working with my partner, Cynthia Shen, for over 8 years now. A lot of you are probably familiar with Cynthia. She's a longtime supporter of Monjade. I'm actually coming to you live from her dining room right now. Our office lost power this morning, so she's been gracious enough to have me. We also just added a new member to our team, Winston Hsiao. You can think of it as Winston without the T. Together, our team works with executives, entrepreneurs, and families across the Bay Area. Focus of our practice is providing holistic solutions focused on financial planning, risk management, and portfolio management. While portfolio management is one part of our job, the investment portfolio is really only a tool. With some more complex client situations, you may have concentrated positions, unique investment structures, or more complex family dynamics that require specific attention. Since the focus of our conversation today is on the impact of COVID-19 on asset management, I think it's important to first talk about our experience throughout this year. It's also actually very interesting to parallel the experiences of this year with some of the more major themes of Monjade presented over the last few years. What we've seen this year is a confluence of so many disruptive technologies. In response to the pandemic, we've witnessed over 5 years of growth and expansion of these technologies pulled forward in just the last 6 months. Your investment choices today probably look a lot different than they did about 5 years ago. How many of you are familiar with names now such as DocuSign, Teladoc, or even some of the vaccine companies such as Moderna? How many of you in the audience work in the hardware industry? All of this explosive growth that we've seen over the last few months has also pulled forward the demand for semiconductors, computing power, cloud services, and even AI. As we take a look back at the first 8 months, there's a lot to unpack. In Q2 of 2020, we experienced one of the worst quarters in the history of the stock market. This was subsequently followed by one of the best quarters in the history of the stock market. In fact, in this past month alone, we experienced the best stock market performance for the month of August in nearly 30 years. What I really hope that you're able to take away from today's discussion is a better understanding of where we stand today, as well as to give you a few insights and lessons that we learned from one of the most volatile periods in recent memory. I want to start the discussion off here, and David kind of highlighted it as well, showing the GDP. When we take a look here at this chart, it shows the GDP of growth of domestic and emerging markets over the last 20 years. What we saw and what we experienced is the deepest recession since World War II. Starting in March, essentially all businesses were shut down and our whole country was put under stay-at-home orders. Obviously a move like this is going to take a major toll on the economy. And we saw unemployment levels hit almost 15% in April. When we look back and compare what we just experienced to that of previous market corrections, it's noticeable how much quicker and how much deeper this experience was. This dark gray line over here represents market performance since February 19th, which is our market peak. It's interesting to compare this directly to this light blue line here, which shows a response in the market following the financial crisis in 2008, our most recent substantial pullback in the market. However, while the recovery in 2008 took multiple years, the 2020 recovery spanned over just a few months. Now let's try to unpiece why this time was so much different. In order to do so, we need to compare how and when responses were made. The first response to key in on, fiscal policy. This is how our government spending and tax policies influence our economic conditions. In response to the pandemic, our government decided to send money directly to both consumers and small businesses as a means of supporting the economy during the shutdown. Some may call this helicopter money. They also intervened in the lending markets through the PPP and the Main Street lending programs. And finally, there was a decision by Congress to guarantee loans from commercial banks and to offer various payment forbearance via the CARES Act. Keep in mind, all of this was done in a matter of weeks, compared to in 2008, where it took almost 8 months for the government to step in to support the economy. It's fairly clear to see that the size of this fiscal package is much greater than anything we've ever seen before. And it's likely to grow over the next few months with additional stimulus packages still in the works. Through all of these actions, Congress has now become a critical player in driving money supply growth, in addition to the Fed, which would traditionally hold this role. Speaking of the Fed, we can see that through monetary policy, the Fed reacted much more swiftly and aggressively with immediate response and direct intervention in the credit markets. We've seen them cut rates to near zero, while also simultaneously expanding their balance sheet through lending vehicles. This is likely to continue into 2021, which has been communicated fairly clearly. A lot of this may be due to lessons learned from the financial crisis in 2008. I'm sure most of the people in the audience are probably young enough to remember what happened in 2008. However, there are some differences between this year and 2008. In 2008, the crisis was man-made, while in 2020 it was not. Also in 2008, the markets were already under a tremendous amount of stress, and they were highly leveraged. This time coming into February, we had one of the lowest unemployment rates in history, as well as one of the best capitalized bank sectors. It's no wonder with that injection of more than $2 trillion in the first couple weeks of the pandemic, we were able to see a pretty immediate response in the stock market. Taking a look at both the financial crisis of 2008 and our current day experiences, this brings us to our first major lesson and takeaway. Don't fight the Fed. Or even in this case, don't fight Uncle Sam. Once that Fed and that government support was announced in mid-April, markets rallied in a very significant way. If you take a look back at the chart of the stock market since the Fed stepped in after 2008, as well as major programs such as quantitative easing, we saw a fairly similar response from 2009 to 2018. Within any investment portfolio, if there's this sort of major support to the market, you should feel much more comfortable adding risk to your portfolio. The next real major takeaway from these last few months is to not let your emotions get in the way of your process. Too many times have we seen our clients, friends, family sell at the market bottom and buy at the market top. How many times have you, whether a new investor or even a seasoned investor, have had regrets after selling a position in recent memory? However, thinking about that investment philosophy only in the short term, it's not effective and it's not an efficient strategy. This stresses the major importance of active management, especially in volatile markets like what we've seen this year. Active management implies consistently monitoring the performance and the positioning of your portfolio while regularly making decisions to buy and to sell. The goal of this process is to outperform the benchmark with much lower volatility. Keep in mind, active management, it doesn't mean day trading. By taking a more active approach to managing your assets, you can take advantage of and be much more efficient with your opportunities. Our firm expects the market to remain fairly volatile for the rest of the year. Keep in mind, we are approaching an election in November, so it's important that you monitor both the markets and your portfolios on a much more active basis. Outside of our portfolios, there are a number of things that we monitor through a system we created that kind of operates like a stoplight. We call this the weight of the evidence, and it's fairly simple and fairly logical. If the majority of our indicators are showing green, or a positive outlook, we'll feel much more comfortable adding risk to the portfolios. On the flip side, if we see a number of indicators in red, we'll reduce our risk and raise our cash positions. Specifically, some of the major market indicators that we look at include economic conditions, credit spreads, the yield curve, momentum, and volatility measured by the VIX index. The VIX is a really interesting indicator to follow as it measures the amount of put options bought on the S&P 500. If you open a market portfolio and you're worried about risk, you can purchase a put option as a type of insurance to hedge your downside. If more people are buying insurance, the price of that insurance goes up. As a result, the greater the market's expectation of risk is for the immediate future. In fact, probably maybe a day or two before some of the major corrections we saw in the market a week back, we actually saw this volatility index start to spike up 10 to 20%. All of these types of analysis helps us to take the emotions out of that portfolio management process. The next takeaway from this experience is the importance of having a plan. Your strategy should encompass your financial situation and lay out specifically what's really important to you. A smart plan covers all of your bases: assets, liabilities, and goals, as well as asset protection. One instance of this is insurance, which is something that Julia would be able to shed much more light on during her presentation. And there are a few others that I can address right now. Within any family, you may have a number of different asset protection goals, which can be achieved using strategies such as special purpose trusts. Also, there are many more very creative solutions to protect your assets. Specifically with our clients, we use our firm's tools to identify potential weaknesses or vulnerabilities in their portfolios. In addition, we utilize a number of analysis tools that help us to stress test portfolios to see how they may respond to potential shocks in the market. Actually, back in early February, these types of simulations were something we did quite often for our clients. Using our tools, we're able to stress test our client portfolios to the specific market condition of the SARS outbreak in 2003, in order to simulate how these portfolios might react if COVID was indeed determined to be on a pandemic scale. All of these steps are crucial in establishing a successful strategy, which is going to look completely different for every single person. Also, keep in mind that throughout your life, you're going to encounter a number of these changes, such as jobs, buying a home, adding a new member to your family, and the educational expenses that come along with it. It's important that you monitor this plan on a frequent basis to make sure that you're still on track. After you've established, what's important to you and what to plan for, you want to build a portfolio that actively reflects that. Your portfolios will most likely look fairly different depending on your life stage, age, and personal risk tolerance. In fact, clients often have multiple portfolios based on different sets of goals. For example, the allocation of a client's family foundation portfolio may look a lot different than their shorter term or tactical portfolios or core retirement portfolios. As you can see here, if you take a look at the 4 major asset classes, there are substantial differences in the risk return profile for each. It's important to create the appropriate asset allocation mix to best suit your individual needs. When using a more actively managed approach, you'll also fine-tune and adjust these allocations given the existing market conditions. The end result here is optimizing your opportunities. When building these portfolios, diversification also has a major role in the type of experience you have. I know that in the Silicon Valley, we're surrounded by some of the largest and most successful technology and biotech companies in the world. This is often reflected in our clients' individual portfolios, whether it be concentrated stock positions from compensation, or even just stocks that our clients like to purchase. We've seen a huge boom in these stocks over the last few months, with a little momentum slowing down over the last 2 weeks. I would say when you see these big outsized moves in the market, you want to take a step back and understand your risks. This next slide here shows the returns of different asset classes over the last 10 years. The box at the top represents the highest performer for that year, while the box at the bottom represents the lowest performer. If we take a look back at the last 2 years, you'll see that US equities has been the top performer. However, taking a look back in 2018, it was US debt. 2017, it was emerging markets equities. I think what you can see pretty clearly here is that not a single sector is consistently the winner every single year. As an active manager, you need to understand how each asset class correlates with each other and build a portfolio with effective allocations to multiple different asset classes. The sum total of this is you achieve a fairly decent return with much lower volatility. That's the key here. If you take a look at this light yellow box of a diversified portfolio, it's pretty high up there in terms of 10-year annual return, as well as low on the volatility scale. Keep in mind, this is only one way to dissect and analyze your portfolios. With the proper tools, you can take a look at it from multiple different directions. I know it's very difficult at this time, not to buy any more Apple or Tesla stock. And I'm not saying that you shouldn't buy these stocks. Just make sure that you understand the risks associated with these positions, and more importantly, how that fits into your overall big picture. One quick chart that I thought a lot of people might find interesting. This chart shows the performance of various market indices between the years of 2000 to 2010. This is a very interesting decade. You'll notice that if you're 100% invested in the S&P 500, you would actually have a negative return, and a pretty sizable negative return of about 9%. However, you'll see that other indices, such as emerging markets, were up pretty significantly. And take a look at where a diversified portfolio kind of falls down. While not up quite as much as EM, still up much more than the S&P 500. This really shows us the importance of asset allocation and diversification. And by working with an expert who can help you to navigate the markets, you can achieve much better results. Just as we've seen on the last slide, US equities has not always historically outperformed. However, if you were to take a look at the market over just the last few months, you probably think otherwise. As this is not an in-person event, I can't ask the crowd to raise your hand if you own Apple, Google, Facebook, or Microsoft. But I'm going to go out on a limb and say that the majority of you probably do. Even more of you probably own assets in a stock market index, such as the S&P 500 or the Nasdaq. whether that be an ETF like SPY or QQQ, or a passive mutual fund tracking the index. These are all very common in retirement portfolios and 401ks. While returns this year have been pretty good, it's important to understand how you're invested and knowing exactly what's in your portfolio. Passive strategies such as these may introduce unwanted risks to investors, particularly during times of increased concentration. Currently, the 5 largest companies in the S&P 500 account for over $7 trillion in market cap and almost 25% of the index, while the top 25 largest companies constitute over 40%. Both are at its highest concentration levels since 2000. Taking a look at this chart, we can see that the performance of these 5 largest companies has also been exponentially higher than the rest of the index. Now let's take a look specifically at technology concentration in the index. We can see here that the concentration of technology alone encompasses almost 40% of the S&P 500. Now, what does that mean for my portfolio? Such a high concentration can also create unwanted overexposures to high momentum and high growth factors, which could drive poor performance if we see markets have a change in leadership, which is typically witnessed around recessions as late cycle outperformers give way to early cycle leaders. How many of you lost money in the markets last Thursday or Friday, or even this past Tuesday? Given the sector concentration in technology, a reversal in this sector's performance also weighs pretty heavily on cap-weighted indices, which brings us to our next lesson: risk management. As an investor, you need to know exactly what you're invested in and what your exposure is. You need to be able to understand what contributes volatility to my portfolio, whether that be a certain sector, asset class, or even country. Specifically, some of our Morgan Stanley tools help us to break down positions such as QQQ, or even entire portfolios of mutual funds and ETFs into their individual components. This gives us a better understanding of where am I invested, or even if I'm potentially over allocated to a certain sector or asset class. When we think about risk management, we need to determine, how do I measure risk? What does this information mean? And finally, what do I do with that information? Think about your portfolio. Are you guys holding 5 or 6 stocks? Or have you throughout the years built up somewhat of a mix of assets? Also, it's very important to realize when to take on risk, as well as when to scale back. Keep in mind that cash is an asset, and it should be utilized as so. Specifically in some of our managed portfolio models, when we saw a number of our indicators kind of begin to shift to that negative territory, we raised more than half of our portfolios in cash heading into February and March, which gave us plenty of dry powder to allocate when that opportunity came up. Now that we've covered the importance of asset allocation and diversification, what if you're an employee of a company or even a company founder where a significant portion of your compensation is issued through stock options or founder shares? You may have a fairly concentrated wealth position hinging on just a single company's performance. So what do? Selling these shares immediately may not be the right decision given the immense tax consequences, but I did want to highlight a few solutions that we utilize for clients in this type of situation. The first is an exchange fund. This is an investment vehicle that offers investors with concentrated positions the opportunity for instant diversification, changing their shares, oftentimes highly appreciated or even restricted stock, for a basket of stocks in a diversified portfolio. In addition, holders of concentrated positions can utilize covered call writing strategies to create income from shares that they would more or less like to keep. And lastly, there are a number of tax efficient strategies that one can adopt, such as charitable remainder trusts or grantor retained annuity trusts, in addition to simple gifting strategies, which help to mitigate some of your concentration risk with instant diversification and immediate tax benefits. If you find yourself in this situation, this is something we can have a conversation on following up today's events. Keep in mind, concentrated positions are not something that you have to live with. There are a number of tools at your disposal which may help you to minimize your tax burden and accomplish what you're really hoping for: diversification. As an astute investor, you may have even seen your wealth grow during this period of massive volatility. You may have significant capital gains in concentrated positions. So what do you do now? Now is a great time to analyze your risks and implement the right strategy. Bringing it all together today, we covered a number of topics of importance for any person in any situation specific to managing their wealth. A few takeaways and lessons. Number 1, don't fight the Fed. Number 2, don't let your emotions get in the way of your success and the importance of active management. Number 3, the importance of having a plan and monitoring that plan, as well as knowing when to take appropriate action. Number 4, building the appropriate portfolio to encompass your goals. In fact, most of the families that we observe and the portfolios that we manage have a number of different goals, which may need a collection of different portfolios representing the complexities of a single family dynamic. It's important that you spend some time working with someone with the right experience to figure out, how do these goals interact with each other? Maybe do I need to give up something in order to reach another goal? Most importantly, how can I maximize what I want to accomplish? The real key here is optimizing your financial positioning and having a portfolio that harmonizes different financial priorities. And the last real takeaway here, the importance of risk management. What to measure, how to measure it, and what can I do? Most times, it's not just adjusting your portfolio alone. That's why we're typically pretty involved with both your tax and legal advisors. Keep in mind that every person's portfolio is going to look completely different because every person's priorities are different. While the pandemic has had tremendous impact on families and health, we hope that you can take a look back at the experience of the last few months and know that there have been a lot of lessons to learn. In fact, for some of you, probably lessons for us to help you learn again after similar experiences such as the tech bubble in 2000 or the financial crisis in 2008. If you didn't learn it then, hopefully you can learn it now. Over the last month, we've seen the market recover to pre-pandemic levels, and many of you were probably fortunate enough to catch some of that upside. Now's your chance to figure out what to do next. I'll ask David to share my contact information. So if you have any more individualized questions or would like a copy of the presentation, please do feel free to reach out directly. Thank you everyone for your time. Happy to answer any questions after the presentation.
Great. Thanks, Ryan. I know there's a few questions, but I want to move on to Julia's presentation first, and then we're going to cover some of their questions that are kind of flowing in through chat during our Q&A session. Julia, I'm going to pass it to you now.
Okay, wonderful. Okay, so let me share the screen here, and then can you see my screen?
Yep, looks great.
Can see my, okay, wonderful, great. So everyone, I'm Julia Hsiao. I'm being in the industry going to be 24 years. So basically, more I'm in the risk management areas. So comparing to Ryan, that he is more focused on the accumulation, but today I'm going more focused on the capital protection side. So this is a very important part. It is more like a financial planning 101. This is a disclaimer. But I think this chart is very important. Okay, so this is almost the second half of the years. So these years have so many changes on the investment, your career, your family, even taxes are a lot of different incentive and support. So I think going to the second half of the year is very important that you need to give yourself a performance report. Just like your kids in the school, how he performed, is a B or A or A+. Same as you need to give yourself a financial report. Is that are you in B or are you in A or you in A+, right? So how can we measure our financials that compared to last year's of yourself, is you getting better or you getting worse? So therefore, I think very important, the second half of the year, you need to have 3 reports. The first one is your balance sheet. So look at your balance, how much assets, how much liability, what's the percentage of the growth? Okay, it's in your real estate, in your stocks, in your 401k. Look at how much is percentage of growth. Is that over the inflation? If the inflation is about 2.53%, did you increase your asset by about 3 to 5%? The second chart you need to do is your income and expenses. Okay, so how much income you make this year, how much potential taxes you need to pay. Maybe this year you save a lot of expenses because you don't travel, a lot of office expenses has been reduced. So maybe income is reduced, but also expenses reduced as well. So maybe at the end of the day, your net saving is not that much different. So that's great news. So then after the next saving, where is the money you need to go to? So the third chart is your cash flow. So how much is your money go to the long term, go to midterm, and go to the short term investment basket? The short term would be like in the next 5 years, I would like to buy a new car, remodel. The midterm could be your kids' education funds, or maybe you want to approaching your retirement age. Or the long term, maybe you are looking for age 70 or 80 and beyond. So it's kind of long term strategy versus midterm and the short term. So put your money into the right basket. And then after that, working on the risk return, working on the asset allocation, and to achieve the goal like Ryan just described, right? So I think I would like you to go to your Dropbox or your Excel to look at your inventory. How much do you have this year's, last year's, increasing percentage? Where's the money goes? So every year you have that chart, that is your GPS. So you can follow that GPS, and then you will feel very comfortable. Like this year's, I'm actually very proud of myself. I have earned so much percentage increase my asset. And I think a lot of people, if you are just a W-2 employee, you might have some regular routine, earn income. You might do some of the unearned income, like your rental, like your investment portfolio. But nevertheless, you still have to figure it out that, what is the goal that you want to go through, right? So I think it's very important that you have that kind of the chart with you. So before that, I like to go to 6 key. Okay, so this is 6 key is very important. It's just like and think about the life stages. When you were young, you are just in the life stages at the age, probably 25 to about age 40. You are just kind of start your new family, raise the kids, buy the new home, and then you have a lot of liability. At age 40 to 60, you are in really like a really good careers. You are peak of your career. You are kind of moving up, and you move to the bigger house. Your kids is going to be in college very soon, or they're already working. That kind of, and you want to focus on from the asset growth. You want to kind of gradually preserve your assets for your own retirement income. So that about age 60 to age 90 or even 100, that's another third stage. That is the stage you want to enjoy your retirement. Maybe you want to do charity. Maybe you want to give to your grandkids or your children as a family wealth presentation and transfer. So I think the 3 life stages, I figured out a lot of people, they can accumulate the most of the wealth is roughly between age 50 to 65. Before they have a lot of obligation, they have a lot of expenses, and I think they cannot make really or save a lot of money. But people, they are in the age about 50 to 65. That is really the goal that you can kind of accumulate a lot of wealth. So that is the one, because we don't really seldomly compare to the people around our stage, especially your family or your friends getting together on the weekend basis. You don't really talk about how much do you do on your family plan? How much is your wealth you accumulated? We don't share among our family. So how should I know how much the wealth comparing to the people like my age? How do they do? All right. Around age 40, what is the typical asset, if you are just a W-2 employee, like I say, either single income or double income, how much is the regular people need to have at the age 40? How about 50? How about 60? How about 70? So, and that way that you know that you can improve. Otherwise, you are just working on yourself. Really don't know, is that I'm in the A plus or in the A or B, or how much should I improve? So that is the way I think a lot, like Ryan and me, that we can use our financial and then our expertise to helping the client. You need to maybe improve this way, improve that way. So I think it's very important to have somebody at least you can talk to and to see where you are. So that is kind of the layouts, but I like to talk, every people in our life stage usually have facing those 6 key areas. The income, right? So you make money, how do you can protect your income? How you protect, if something happened to you, you cannot work today, either become disabled or either you are pass away, how your family can maintain the same standard of living. So your capital risk, your money, where you going to do investment, real estate, stock, gold, you know, those areas. So you make a lot of money, how can you save your money? So the tax planning, the income tax planning, especially important yearly basis, how can you reduce your taxes? So you have accumulate enough asset, how can you protect your assets? Are there other way to protect your asset in case you get lawsuit? And then finally, you go to maybe your golden 10 years before your retirement and after 10 years after retirement. So how can you calculate your retirement income? How much you need to have? Are you afford to retire now? Or, you know, how can you retire comfortably, retirement planning? Where are the sources of your retirement income? Finally, wealth transfer plan. Do you have good legal documents? Can you pass your asset to the people you love without paying extra taxes? So that is kind of the 6 area I'm going to talk about, but more of the, I probably more focus on some area, and I will kind of lightly discuss the other area because I want to focus on a couple area that's important to you. Okay, so this is the first one, income protection. So this COVID-19 people worry about, you know, the risk management, right? And there's a couple things and people always confused. I already have a life insurance. Okay, maybe I don't need to buy extra because company cover me. But do you know if you leave the company, the life insurance that you cannot be portable? Okay, and life insurance is increasing when you're getting older, and it's more important your health getting worse. Okay, I figured out recently a lot of young adults buying life insurance because they are afraid of the risk and everything. I figured out most of recently the young adults, their health is worse than 40 years ago, like my age. Okay, when my age, people are in the age 35, a lot of people, they can get the best rating, select prefer, because they are no medication, they are healthy, they exercise a lot. But recently I found out a lot of young adults, they are either on medication, depression, anxiety, or because of a lot of symptoms, they cannot qualify for best rating. So I kind of worry about little bit about health situation, about our younger generation. Okay, maybe they drink too much wine because they have a party all the time, right? Okay, Ryan and Debbie probably around that age. But anyway, so, okay, so that's life insurance. And the secondly, disability. You have a short-term disability covered by your Social Security, about long-term disability. Did you purchase your long-term disability through company? Usually company offer really good plan. Okay, so that's become when you are disabled, that you can replace your income. If not, then you need to buy your own disability insurance, which is actually very expensive than usually typical term life. Because disability can happen anytime, but death usually happen when the life expectancy occur, which is about age 83 to 87. So that's why disability happen much earlier, the premium is much higher. Yesterday, just another client that he is about 39, his income is about $250,000, he want to buy 70% of the annual monthly income, and which is about $6,000 a month, even we cannot go to the top. The annual premium, and this is a cover to the age 67, the annual premium is about $5,000. It is much more expensive than the term life, but you cannot, don't have it, you need to have some sort of disability insurance, either through company or individually owned. People also confused about long-term care. They think disability is a long-term care and company offer that. No, most of the company do not offer this long-term care program. So what is a long-term care? The long-term care is when you cannot perform like your daily activity. What are daily activity? So eating and bathing and dressing and toileting and transferring. This is every day when you walk out, you need to do. If you cannot perform 2 out of 6 daily activity, like for example, you stroke, or you are a computer engineer and you type too much in front of the computer and you paralyzed, you cannot move at that time, then you cannot dress and you cannot shower. And that time you qualify for long-term disability if you have that symptom over 90 days. Okay, it's not short-term, it's a long-term. And that is not Medicare, because Medicare actually only cover 100 days of the long-term care. Okay, because Medicare is acute care. It's a medical insurance alternative. That's not the long-term care. Long-term care is you hire somebody to care for you, okay, because they have to provide the daily activity for you, okay? So this is all the risk that you need to cover: life insurance, disability, long-term care, medical insurance, okay? So think about how much do you have currently? How much life insurance do you have right now? How much do you have disability? How about long-term care? What is a good time to buy the long-term care? This is all analysis that you need to talk to the foundation, because it's just like a pyramid. No matter how you are, I think each family need to have a pyramid. So the pyramid, that will be very, very stable, right? Because the pyramid, that they will not flip over because they have a very solid foundation. And that is the risk management side. And I think insurance protection, no matter it's a life insurance, health insurance, this is all the foundation part. I just want to put a little bit notes on the life insurance. Life insurance is very complicated. It's a term life, it's a permanent life. In the permanent life, which is mean not the term life, the permanent life has 2 types of the insurance. One is a whole life, one is universal life. Okay, typically, and people confuse. People think if my policy is not term life, must be whole life. But when I look at their policy, usually they are universal life. Okay, so the whole life is 3 guarantee. They are cash value guarantee, premium guarantee, and death benefit guarantee. The universal life, usually that's not guaranteed. Okay, basically they are by term life and they are investor differences. But right now, currently, a lot of insurance companies design the universal life with a guarantee, which is good. So basically, they can either guarantee cash value or they have a guaranteed death benefit, as long as you pay the required premium. Okay, so I think insurance, you have to buy guarantee. Okay, this is, I cannot emphasize enough. Insurance, you have to buy guarantee. And the non-guaranteed product, you should defer that to investment arena, in the retirement or your regular investment or your real estate. Insurance is the one is looking for peace of mind. When you are getting older at age 90, at age 100, you are looking, can the company pay my beneficiary as a promise? So that's why you want to buy guaranteed products. The other non-guaranteed product, you should go outside the insurance. Don't mix up the risk versus the guaranteed peace of mind put together. Those 2 characters, I think, cannot match very well. Okay, so even though you are young, you have a very good smart mind that you can monitor the market in the life insurance. But when you're getting older, you are age 80 and 90, you don't have that mind. You want to be peace of mind. And if you cannot manage the investment under your life insurance, that will be trouble. You may lose all the benefits, not even cash value, premium, death benefit, all are gone. Okay, so I just want to mention to you here, look at your life insurance, review that. Is that enough? How much do you need? Is that guarantee? Is a whole life, is term, or do you need to add on? It's just like when you purchase a home. Initially, you just rent a house and then you buy a small house, but later on you need to upgrade, right? You want to move to the better insurance plan or bigger insurance plan. Okay, so that is the risk income replacement side. So let's go to the next page. Okay. Okay. So this is a personal asset. We don't have a lot of business owner here, so I just want to pass this stage, because as a business owner, you also need to know how to protect your employee, reduce your tax liability. But I think today I'm going to pass this one. The income tax reduction, which is, I think I will probably hope that Monty J or the other financial planner that we can talk about the income tax, because this year's especially a lot of different income tax. They are just changing almost on monthly basis. Yesterday, our government just announced if the PPP loan, usually that's for small business owner, usually that is a taxable, but California say we are going to be treated as a non-taxable. It's a good news because California still haven't recovered yet, right? And then if you are just lose your business revenue more than 50%, and you are still hiring the people, each employee, they give 1,000 credit for July to September. So maybe you qualify. Okay, so just pay attention with a lot of income taxes in support and the reduction. And you know, Trump is talking about the our payroll taxes being waived. We don't know what happened, but I just pay attention to a lot of income tax deduction and benefit for these years. Okay, so I think especially toward the end of the year, you also need to monitor your investment portfolio. This year's the people probably encounter a huge loss, right? So maybe you should take the opportunity to harvest the gain to offset your loss. Is substantially important, especially if you are in the mutual fund arena. There is a lot of hidden gain and loss, and you need to exercise it, or you need to talk to your advisor. Even though you are stock ETF arena, you also need to pay attention on the non-qualified plan. So I think not just the expenses part, but on the investment part this year, especially, you need to pay a lot of attention on that part. Okay, so I want to move forward to our fourth topics on the asset protection. Like I mentioned, maybe right now you have a home, you have one rental, you have a couple of the retirement income, retirement asset, and non-qualified money. How can you protect your asset? If you have a couple rental, you are afraid of the tenant sued you, and then you might file bankruptcy, right? California, they usually don't protect the debtor that well. Okay, Florida is really good, right? But not in California. So how can you protect your asset? Usually look at insurance. That's number one. Umbrella insurance. Go to your home, your car insurance, and look at your umbrella. Because if you, for any reason, and in an intentional get the lawsuits, at least some of the umbrella can cover of your liability. Okay, so that is the insurance I want to look at. The renter insurance, the homeowner insurance, this is all you need to buy enough. Okay, myself, that I actually have a 10 million liability insurance, and maybe I need to pay premium much higher, but I think more important is that you just need to cover yourself if in case something happened to you, right? And our is professional, in the professional industry, so that means it's unlimited coverage. You need to protect yourself, and same as a doctor, lawyer, but I think the other person, if you have a rental income, you also need to pay attention. Insurance, and also incorporation. So maybe you have a couple rental, you don't want to get sued, you want to incorporate in the LLC, LLP, S corporation, C corporation, all different type. Is kind of shelter your corporate liability versus your personal liability. Okay, so corporation. The third one, irrevocable trust. So revocable trust doesn't protect you from liability shelter. Irrevocable, okay, that means that you already give away your asset. You have no control. You cannot amend your trust. In that way, of course, this asset doesn't belong to you. So you will be asset protected. So irrevocable trust planning, you lose control, you lose flexibility, but you got asset protection. So it's not a lot of people will do that, but necessary. You want to protect your special need kids, or you want to have a lot of asset you want to pass on your next generation. That is some of the irrevocable planning you want to think about, not just only for tax purpose, but as well as for the asset protection purpose. Okay, so this one, insurance, corporation, and irrevocable trust planning. Okay, so let's talk about, everybody needs this very important topics, retirement. Even my kids, okay, they are just age 30 and 35. They are every day, they just say, okay, I like to retire tomorrow. I don't know, but what the kids, adults, they say, they always say, I work so hard, I want to retire tomorrow. But anyway, but I think everybody want to retire earlier, right? So how can you have a financial independence? So this is very important, that how is usually, I think that the people need to calculate how much cash value you need if you retired. So the way we calculate our like a sheet, 3 sheets we just mentioned, also help you to analyze if you retire, how much money do you need. But you will increase your medical expenses, you will increase your travel expenses, maybe you will increase your gift expenses because you like to give to your kids or your grandkids, right? So don't underestimate about your retirement expenses, all right? But then after that, you say, how can I have that retirement sources of the income? Maybe from your 401k, your IRA, your annuity, okay, your rental income, your regular investment account, your cash value on the life insurance. That is also important part. Okay, so you kind of doing all the analysis. How much is the taxable? 401k, IRA, annuity, rental, might be taxable. Maybe some of them are not taxable. Roth IRA, your municipal bonds, your cash value from the life insurance, and annuity, if that's not qualified, only portion of them is taxable. So you need to calculate how much is pre-tax, how much is tax-free, and then how much is the third one, how much is the guarantee. So you can just continue to withdraw the money without worry too much. So that is kind of guaranteed stream of the income, like a Social Security. Maybe you can design on the annuity and the life insurance part. Maybe on your investment account, you also want to set up a systematic withdrawal, right? So like a 4% is golden rule. You never run out of money by withdraw 4%. So you kind of getting those as a guaranteed stream of the income. Then you have unscheduled income, which is like your regular investment account. If you want to have a travel, family reunion, 70 years old birthday celebration, and need to have 100,000 expenses, that's the money you can come in from. So calculate the sources of your retirement income, calculate what is the fixed extreme of the income, and what is unscheduled, the income you can pull in from, okay? And of course, stress test, like Ryan just mentioned, you also need to put all those assets into different baskets, and then in order to get the money or where to get the money, and this is all need to be like reviewed and analyzed. Okay, so before the retirement income, even though you have a really good plan, you say retire at age 65, I'm going to live to age 100, I have a 35 years, each year I'm going to spend after tax 10,000 a month. Okay, so then after that, you calculate where is the money, but don't forget, the one thing is very important, is the long-term care. Okay, actually, we've been advised, if you are in recommended clients as a retirement planning, if you never mention about the long-term care, I'm actually malpractice. Okay, why? Because long-term care is part of the retirement. Retirement is mean that you can, based on your plan A, Schedule A, that each month you get the money out, and that is like a plan A. Everything goes smoothly, that's no problem. But what if you become Alzheimer, okay, you become stroke, and then you need to somebody to taking care of you for 5-6 years. Typically, it's about 4 to 5 years. So that is very expensive. Currently in California, if you live to the nursing home, that's about 10,000 a month. If you have a home care, about 6,000 a month. And this is an increase almost 5 to 10% each year, the increase the cost. Why? Because it's a human cost. If human costs increase, labor costs increase, your long-term care cost is also increased too. So therefore, the people, they want to buy the long-term care, but they say, oh, I'm probably too old to buy it because must be very expensive for me. I'm age 65. But the people, they are too young. I don't need the long-term care because I'm only age 40. So why should I buy the long-term care right now? So it's kind of confused. When is a good time that you should buy this long-term care plan? If you don't want to buy, at least you want to figure it out. Where is your long-term care asset coming from? Are you going to sell your retirement as $1 million? Are you going to sell your rental as $1 million? But don't forget, you sell your retirement, you sell your rental, you have to pay the income tax first. And that's about 40%. So even $1 million, you actually only have about 600,000. Okay. So I think find out a good long-term care plan, and everybody can figure out a good long-term care plan. Doesn't matter how much is the budget. At least you need to have something, and then you can upgrade it later on. Okay, so without a long-term care plan, it's not a very good complete retirement plan. Luckily, for the past 20 years, people pay more attention about live too long. Okay, before I joined the company 23 years ago, people only worry about die too soon. Okay, so that's why life insurance come to a very, very big player. But people right now more worry about how about if I live too long, then I run out of money, then that's become a resources. And long-term care is also one of the live too long products. Because I'm healthy, people say, hey, Julia, I'm actually very healthy. I exercise, I don't eat this, I don't eat that. I can live to age 100. I say, congratulations, you are same as me. I have a very good gene. I think I can live to beyond age 100. So we are the higher risk of the long-term care people. Okay, we are the target clients because people live very healthy. That is the time they're mentally very healthy. Their heart is really good, but their body, their health, their knees, they cannot move very smoothly. And that's the time they need the long-term care. Okay, so it's not for the unhealthy people. It's actually more for the healthy people. Okay, so that's kind of retirement. Think about how much you need and your risk management on the long-term care part. Lastly, I want to go to the estate planning. This is cover some of the legal documents. And this is, of course, estate planning, it's not just the living trust. Okay, estate planning is cover the doable power of attorney for healthcare and doable power of attorney for asset management. It's just not that when you die, where's the asset go? Who is the successor trustee to manage your asset? But also, if you become disabled, coma, who is going to manage your property or your health care? Especially come with the long-term care, because people have I look at the parents at the age 90, okay, they have a long-term care policy, or age 80 have a long-term care policy purchased a long time ago. So think about it, when they have a long-term care, really need to trigger long-term care planning. Who is going to make the decision for your elderly parents? The children. So children need to understand the parents' long-term care policy. That's how they make that decision. Is home care, is nursing home, which one is suitable for the parents? So it's good to reduce the financial stress, but it's also very important at this time. This is part of your estate planning, doable power attorney for healthcare, especially also for the long-term care part. And the revocable living trust is actually only avoid probate. That's the only purpose right here. Okay, irrevocable is for tax planning, but revocable is just basically that I just want to make sure something happened to me, who are my beneficiary, is my spouse or my children. Here, I want to emphasize based on my experiences. I used to recommend the clients use family trust as a life insurance or annuity beneficiary, but I think right now, because the IRS, they don't understand what is the content of your living trust. And people right now, living trust is very creative. Used to 30 years ago, when we do the living trust, we are just Hsiao living trust, and we are very use our name, right? Because I think that is more like a compliance or something. But right now, people use happy trust, dragon trust, this trust and that trust. And then you don't know if this is revocable or irrevocable. Who are the beneficiary? They have no clue. IRS have no clue. Therefore, IRS require that you have to provide a tax ID, even though it's a revocable trust as a beneficiary. So this is really take times, and especially in the IRA accounts, you cannot have an inherit IRA or spousal IRA. It's become a lot of burdensome. So therefore, I recommend life insurance, you use the individual as a beneficiary, but last one, like as a trust, is you catch up the third beneficiary, like your spouse first, your kids second, and then your third beneficiary. That would be your living trust. It means that if something happened to all of you, at least you have a catch-up living trust that to protect, not to go through the probate, right? Annuity is the same thing, spouse, kids, and your family trust. So that way, and then the other one, you just need to change the title. That's as your trust. People set up the trust, but they don't review their living trust, okay? They don't funding their living trust. So your bank account, your real estate, you need to put into the name of the trust, okay? So that's kind of the estate planning part. But lastly, I just want to focus on our estate taxes. Right now, everybody knows 11.59, 58 million, 11.58 million, right? And this is more like an index increase, but we don't know what happened 2026, and Democrats going to reduce to 3.5 million. We don't know. Setup basis may be removed by carryover basis, so we don't know what happened. But doesn't matter those politicians, why they change the law. The more important, you have to be in the driver's seat. You have to control your wheels. So you need to have your own planning. And then doesn't matter how those politicians change the law. You just, because we cannot measure when we're going to die. If you are just particularly know you're going to die, that's like the problem. You don't know when you're going to die. So the more important, control your financial and estate planning. And then you just based on the law, you kind of moderately change some of the difference allocation or some of the trust document. So very important. 11.58 million is just this year, but and you give exclusion. Like I can give David 15,000. This all set at the end of the year. Next year, you have another 15,000, your cash or your life insurance to your kids. This is maybe a good time to think about the gift tax on top of this 11.58 million. Lastly, I want to catch up new tax law. Last year's December, we used to have a gift and the estate tax we call the unified credit. That means if you use your gift tax amount will be reduced by the estate tax amount. But last year's December, there has a very particular tax court. The ruling is that if I give 11.58 million this year's, okay, because this year is 11.58 million. Unfortunately, when I die, the exemption is become 5 million. Before December of last year's, the law is that you give 11 million. When you die, the estate tax is 5 million. The 6 million you need to go back to calculate your estate tax due. Okay, so that means the end of the day, they calculate how much you own have, because you only have a 6 million, you only have 5 million. So you give 11 million, that 6 million need to recalculate your estate taxes. But last year's, they have a different rule. They say you give away 11 million, even though at the time of the death, your estate taxes is 5 million, the 6 million is gone. We don't claw back. That is a big, big, big law change. So people want to give away, maybe you want to think about take opportunity of higher gift tax credit at this moment. Okay, so that's kind of some of the update I just want to share with you. So today we go over with the income protection on the reinsurance side. And Ryan talked about the investment allocation. We talk about a little bit about income tax deduction and income tax review. We talk about the retirement part and asset protection part. And finally, we talk about estate planning part. So it's kind of in, I don't know, 20 minutes, talk about all 6 subjects. And thank you so much. You have question, give me a raise your hands and we can talk about that.
Great. Thank you, Julia, for that very detailed presentation on insurance. Can you stop sharing your screen and then we'll get the panel back on?
Okay, sure.
Thank you. Awesome, great. Well, I have a question before we go into questions from the audience. So I know, much of us during COVID have been, watching the markets go crazy. And I'm very interested to see, like, from both your perspectives, what have you seen as the most number of questions? So I'm going to go to Ryan first, though. Like, what have people been coming to you with most questions on or most concerns about? Like, what are those like common questions?
I think for us, over allocation. A lot of our clients, majority of our clients work in the Silicon Valley, work for a lot of these major tech companies. A big portion of their wealth is allocated in a single company stock. So I think a big worry for them is do I have too much risk in a single name? And for us, it's really important that we diversify that risk through a number of different strategies. So I would say, concentration specifically in technology is a question that we get quite often.
And so there was a question from Kat Hung in the audience who was asking, can you give an example of an exchange fund, or like how does that actually work? What are the mechanics, I guess, behind it? And can you talk a little bit more about that structure? Because it kind of solves this concentration problem.
So the two most common that we see are issued by Goldman Sachs and Eaton Vance. So essentially what you are, let's just say I'm an employee at Google and I have X number of shares. I would essentially input my shares into a pool, which creates a diversified portfolio. Now, not everyone gets accepted. Oftentimes there might have too high of an allocation to a certain stock. So typically you'll file an application first. And then once you're accepted, they're willing to take on your shares. Then you can kind of preview what's actually inside the exchange fund. Typically the holding period is about 7 years. At that time, you can either take shares of a diversified portfolio, or you could just take your stock back. But during that period of time, there's no sales involved. Essentially, you're just getting a pro rata share of that pool of investments. So there's no tax consequences.
Interesting. And so like, so you're allocating your shares into this pool with everyone else. And so the approval process is just to make sure that the pool is diversified enough. Is that kind of correct? Your thoughts about?
Yep. So let's just say a lot of people at Google want to contribute their shares. So it's more than 20% of the portfolio. And I just made up that number. I'm not sure what their exact standards are, but if there's too much Google, then they won't let you contribute. But the more people contribute to these funds, the more diversified it gets. And typically we see them close probably about once a quarter.
Got it. That's fantastic. I'm gonna move to you, Julia. During COVID, what kind of questions have you been like kind of faced with the most of from an insurance side, and like how you've been responding?
Sure. Okay. So the insurance side, the number one is this COVID-19 increase the mortality risk? That people die more than people, but in reality, actually, because of the COVID-19, even though people die from this incidence is higher, but the other one is actually lower. So and then of course that interest rate is so low, is insurance company, how can they make profits? Are they going to increase the premium? But I think some company indeed they increase the premium, something like Prudential, for example, because of they think the risk is too high and the investment return on the bonds portfolio. Insurance company put their portfolio, most of them, into the bonds portfolio, and because the bond interest rate is going to be very low for quite a period of the time, so therefore that some of the insurance company cannot have that enough reserve to cover the risk, so therefore they have to increase the insurance cost. But some product, because they are different design, they have a lot of reserve in the policy, so they haven't increased the premium yet, like a whole life part. So people asking, is that a good time to buy the insurance? And I say, well, yes, because you are young, you are healthy. You don't compare to outside environment. You cannot say what's the good time to buy the real estate right now. You cannot compare to 30 years ago. You just have compared to whatever available right now in front of you, and compare yourself, because yourself right now is only the youngest and healthiest compared to the future. So I think, yeah, people asking about very good questions, but I think insurance company already have some of the answers for that.
Great. And I know there's a specific question from Claudia saying to you, Julia, there's the FIRE movement is on the rage. Lots of young people retired in their 30s and followed the 4% rule to take money out from their savings. Do you think this is a good idea?
Yeah, I think you retire too early unless you need to have a very big money. Okay, so otherwise, I think retirement earlier, it just seems like people probably just burn out from working too hard, right? But I think this is another way. I think even though retire, you need to know what you need to do. Okay, it's very important because if you are just retired at age 30, unless you make a big hit and then you got like a 10 million, 8 million, so you can retire comfortably. But a lot of people is not that lucky, right? So I think it just based on your normal retirement age. Of course, 4% may not be enough because that means you need to have a very big capital, 8 million. But if not, probably you just work on your rules and enjoy your retirement age when you come to the right age.
Great. So I have a question for the both of you, and this has been bothering me a little, quite a bit. So we've gone down to like zero bound interest rates, right? So bond prices are incredibly high, returns are very low, and so like what I'm seeing is that there's more volatility actually in the bond prices, just because like small movements in interest price will actually move the bond prices quite a bit. So I want to move to maybe Ryan first. When we look at a traditional asset allocation portfolio, there's like this 60-40 concept. I know Ray Dalio has more like a 55% in bond kind of model, like of a fixed income. What are you like? How are you guys thinking about this fixed income instrument itself in this next like 10 years?
Yeah, I think we've approached a pretty interesting point in time. Just to point out, some days in March, we saw some of our money market type funds down almost 2 to 5%. And we buy those funds to preserve our assets. So we've seen incredible amounts of volatility within fixed income. And I would say historical portfolio, 60-40, we are still invested in fixed income, but it's not that traditional. Like we're not expecting to get 3% yield. It's much more like between 1.5, maybe 2, depending on credit quality. So I think you just kind of have to reassess what your portfolio looks like. But you still need that fixed income. It's still a very important part of your portfolio because typically it has, a negative to lower correlation with the market. So in March, when we saw the market down 35%, a lot of our fixed income positions were actually up. So that's really the key of having it in your portfolio.
Right. And so like when I think about compositions of like fixed income side, like are you recommending clients to go now diversify internationally? Like look at other places. Like I know I've been hearing more like China fixed income now is becoming more a thing, but it's almost like super hard to get into, non-liquid, etc.
Yeah. So liquidity is a big issue. Also, currency risk. We've seen the US dollar depreciate pretty severely, in the last couple months. So those positions might look good. And, considering we're printing $6 trillion for stimulus, who knows where the value of the US dollar will be 6 to 9 months from now. But we do recommend, in terms of risk, we allocate our clients mostly domestically. It's the most stable, not getting a lot of yield, but it's much more predictable than, international or especially emerging markets.
Sure. Thanks. And Julia, how's like, I know you covered this a little bit in terms of like insurance companies and their spreads and their ability to make profits. How has this impacted your side of a business?
Okay, I want to kind of touch a little bit basis on the bonds portfolio regarding to the interest rate. So when the interest rate going very, very low, usually dividend is actually kind of limited, but actually capital appreciation is better. Okay, so that is kind of one way to think about the overall your bonds portfolio. But also the other thing is that in the bonds portfolio side, there are so many different, from the high yield corporate bonds to investment grade corporate bonds to the municipal bonds, high yields municipal bonds, and also the high quality municipal bonds. US Treasury, there are so many fixed income, even though the inflation tips, there are so many fixed income portfolio, and they have all different degree related to the market correlation and as well as the interest rate. So I think it's not just the black and white, it's just very different degree. Even though in the fixed income portfolio, you need to figure out that, what kind of the components you want to put into as an asset allocation, even though in the bonds portfolio. So I think it's just not just the black and white. People in the high risk area, and you can take a little bit more risk. Maybe you want to take a BBB. Municipal bond is less default than the AAA corporate bonds. is about 0.8%. So it's very, very attractive allocation on BBB municipal bonds. So I just want to kind of pay attention. It's very good kind of asset allocation with your high risk equity position. That is kind of, I just want to put a little bit on that one. But the insurance policy, talk about the insurance policy, interest rates that did indeed impact about the insurance portfolio. Insurance put about 80% to 88% into the we call fixed income portfolio. They are corporate bonds, they are real estate mortgage, they are policy loan, they are government bonds. So they put all the interest rate in that allocation. So that definitely hurts. So when I joined the company about 24 years ago, at that time, the interest rate usually is about 8%, but right now they are kind of decreasing. Right now, you know, a lot of interest rate, I mean, the company return, overall return, that it's decreasing right now. So interest rate does affect the insurance company return. However, insurance company does allow about 12 to 15%. They can input into the equity position. So equity position, they can do, they call the strategic alliance, asset management. And this equity in the past 10 years, when interest rate is really low, the equity return is actually more than better than expected. So they can compensate the low interest rate environment, the loss on the money, the bonds. But the insurance company, they invest the money, it's a very, very long-term dollar cost averaging, because every day each person pay the premium. They use that premium to buy that time, the maturity and the quality of the bonds. So think about 1 year that you have 365 times. And if that one policy owner, he still live and he is age 100, then you have 100 years times 365 times of different asset allocation and dollar cost averaging. So if just one period of the time, the low interest rate really doesn't affect that insurance general return a lot. But if the long term, that, you know, very, very long term, like 30 years, then definitely that really hurts the insurance portfolio as overall. But I don't think we should keep this. I mean, I don't think that we will keep the long interest rate for so long for that time. You know, eventually the interest rate going back, we need to have an inflation to balance the bubble of the asset. So at that time, I think the insurance portfolio will coming better a little bit. So we couldn't look at the short period of time, we look at the long period of the time.
Fantastic. I know we're reaching kind of, go ahead,
I
Ryan.
was just gonna say, if it's really like income that we're talking about, a lot of our clients will use covered call writing strategies. So, you know, it's not a fixed income vehicle, but you could still get, you know, maybe 3 to 5% writing calls on, you know, your company stock, or maybe stock you've held for a long time that have huge cap gains. So outside of fixed income, you know, there are still income generating ideas.
Great. I know we're kind of reaching on the end of our time before we end our program today. Any final like thoughts that you like our audience to have notes of today? Ryan, you want to go first for kind of like
Sure.
a wrap up ideas or thoughts?
Yeah, so I would say, you know, any client in any position, you know, whether you're 20, whether you're 60, you know, make sure you take a total of all of your assets. You know, typically with our clients, our plan takes a look at, what do I own? You know, what do I owe? What's important to me? And then, you know, try to figure out, do I have enough assets to get there? Or do I need to reallocate some of my positions to, you know, to achieve a better goal? So I would say, if you have some time, you know, take some time to talk to someone about this, get a total of what you own and figure out what's important to you.
Great, thank you. Julia?
Yeah, okay, so I also go back to our 6 wheels, 6 key area. So make sure, yeah, you know, where you want to focus on in the short term, mid-term, and the long term. Education funds, remodel, buy a new home, retirement, those kind of things. And make sure you also make a goal, how much money, how much asset do you want to have at the age 50, okay, at age 60. So you have that goal, and then you will say, how can I reach there? Maybe you need to work harder, make more money, or maybe you save expenses, maybe you do investment more aggressively, but you also have some balance sheets. So it's a good time, go back to your portfolio. It just give yourself a homework. Go back to figure out how much asset do you have, what's the last year's value, this year's value, and then, do they increase by what percentage, and go to your income and expenses analysis and go to your cash flow analysis. So by review those 3 charts by semi-annually, I did on July, the beginning of the July, and also the end of the December. So you can figure out what's the next year's steps that you want to do. So I think it's a good time that you get yourself give your performance report.
Great. Let's see. I have one question just popped up in our Q&A, and it's from Lytton, and it's how do you recommend going about finding a professional to talk to about your financial position? Like, what qualities do you look for in an advisor? And I think this is oftentimes for me, like, also a very hard question, right? It's like, there's so many people, everyone's a financial advisor, everyone's insurance broker, right? Like, et cetera, et cetera. Like, what do you guys recommend? Like, and obviously, like, you guys are both in that position, but what do you guys think?
I think what's most important here is, trust. You got to work with someone who you believe in, and who will do a good job for you. And I'm both Julie and I are trustworthy professionals, so I would say that's probably the most important thing that you need to find with someone, and someone who gets you.
Okay, I think an advisor is just, each person is different. You cannot use the prototype. Maybe 80% are common, but 20% are definitely different. So you have to listen. Very important, listen to what your clients describe, what they want about the money, about their financial goal. And because of you listen, and you can think about how can you customizely design the plan suitable for them. Okay, so may not be suitable somebody else, but suitable for them. I think as a financial advisor, you also look at the reputation. That is just a customized, but also the reputation. If you can do a reputation reference checkup, maybe if she or he can still be in the market, must have some good referral reputation. And I think and also you interview with that advisor. Do you feel comfortable working with? Is the chemistry really match? Do they listen? But also, this is like just initially you engage, but most important is that the financial advisor have to deliver the promise each year. It's not just when you set up initially, but more important, you need to annually review your client portfolio, because everything will change, okay? So you need to have an advisor hand-on with you, give you a lifetime coach, and kind of let them know, are you in good shape, or do you need to do things? So number one complaint in the market, it just, the advisor hit and run, give them a plan, and later on they call them, they don't answer the phone call. That's number one complaint in the market. So you need to have a very, very good advisor. It's just not give you a very good proposal, listen to what you think, but most important, follow-up services. That is the key.
So yeah, I love this conversation, and both of you guys hit on something that's incredibly important, I think, which is process, right? So there's a systematic framework and a process, and I always am a big believer of process. This consistency drives success. You might not get it right perfectly the first time, but because you go back and review it, you consistently engage. This is a lifetime journey. So Lytton, I think on this is really my kind of 2 cents on this is talk to a couple of advisors, whether it be on the insurance side or the financial side. Everyone's going to do things differently. And I think this is one of those things where it's like, it's actually better to go a little slower than fast to really solidify on one person. But over the course of time, I think people's character in this space really flushes out, and you can get a better perspective of like, what are they really after? Are they really helping me build my portfolio, really helping me think through things? So I think like more people, and then just time, I think is a really important. With that, I want to thank both Ryan and also Julia for joining us today. Thank you for your insights. We will have your contact information put on our website for this event, along with, if you allow us to, your presentation. So we'll put them also there on the site as well, so people can reference it. And thank you again very much for participating and joining with us today.
Thank you for having me. Thanks,
David.
So much.
Thanks, Julia.
So I'm going to wrap up with a little bit of a logistics. A little quick reminder that our mentorship program is just about to kick off. If you know anyone that is interested in joining our program, please send them to our website at montejade.org/mentorship. We've got a great list of speakers and notables coming this year to support our program again. So we want to thank all of our supporters. In terms of next events coming up, we have a board-to-board interview with Peter Chu. He was a former investor and a former chairman of Monte Jade West. We have a couple of fun events, which is happy hour. We have a wireless communication forum, our mentorship workshops. Coming down the line, we also have Carol Carpenter, CMO of VMware, who will speak, and then Wen Shea and Li Guangyi, who will speak with us in November. Lastly, I want to thank again our virtual sponsors, Deloitte, VenturePack Law, and Silicon Motion, and New York Life for supporting us this year during COVID in our virtual series. And again, all our annual sponsors, UMC and Deloitte especially, for their long-term support for us. With that, we will wrap today's program. I want to thank everyone for taking the time on a Saturday to come out and learn a little bit more about financial management and insurance and protection. With that, have a great weekend and stay safe, stay out of the smoke. And we look forward to seeing you guys soon at our next event. Thank you very much.
Thank you. Bye-bye.
Thanks.
Bye.
Bye.